Have you ever wondered what happens when the financial markets run out of breath? When the very thing that keeps trading alive suddenly becomes scarce? Well, we're about to find out. Because right now, beneath all the holiday cheer and year-end optimism, something dangerous is brewing in the shadows of our financial system. A liquidity crisis that could reshape everything we thought we knew about investing and trading. Most people think liquidity is just some fancy Wall Street term that doesn't affect them. They imagine it's something only hedge fund managers and investment bankers need to worry about. But the truth is, liquidity is the oxygen of every financial market. It's what allows you to buy stocks, sell bonds, trade currencies, and move money around the globe. And when it disappears, everything stops working. Right now, we're heading towards December 31st, a date that could trigger the most severe liquidity crunch we've seen in decades. The signs are everywhere if you know where to look. Central banks are tightening their grip, major financial institutions are hoarding cash, trading volumes are dropping, and the smart money is quietly positioning itself for what's coming next. What I'm about to show you isn't just theory. It's not speculation or fear-mongering. It's a pattern that repeats itself throughout financial history, and the evidence suggests we're walking straight into another cycle. The question isn't whether a liquidity crisis will happen. The question is whether you'll be prepared when it does. In this video, I'm going to break down exactly what a liquidity crisis looks like, why December 31st is the trigger date everyone's watching, and most importantly, what happens to your investments, your savings, and your financial future when the markets freeze up. By the end, you'll understand not just what's coming, but how to position yourself to survive and even thrive during one of the most challenging periods in modern finance. But first, let me tell you a story that will change how you think about liquidity forever. It was March 2020. The world was shutting down. Panic was spreading faster than any virus. And in the span of just a few weeks, something unprecedented happened in the financial markets. Not just stocks crashed, not just bonds fell. Everything fell. Gold, treasuries, real estate investment trusts, even money market funds. Assets that were supposed to be safe havens were selling off alongside the riskiest investments. Investors were calling their brokers, demanding to sell everything. But here's the terrifying part. There were no buyers. The market makers who usually provide liquidity had stepped away. The algorithms that normally smooth out price movements had shut down.
For the first time in generations, the most liquid markets in the world had simply frozen. That's what a liquidity crisis looks like. It's not just about one asset class or one sector. It's about the entire financial system losing its ability to function. Prices don't just fall, they collapse because there's nobody willing to catch them on the way down. Now, you might be thinking that was just a once-in-a-lifetime event, something caused by a global pandemic that we'll never see again. But you'd be wrong, because liquidity crises follow predictable patterns. They build slowly, triggered by specific conditions, and then explode with devastating speed. The conditions building right now are eerily similar to what we saw before previous crashes. Debt levels are at historic highs, interest rates are rising, central banks are removing stimulus, and most importantly, the calendar is working against us. You see, December 31st isn't just any date. It's the end of the fiscal year for most financial institutions. It's when banks need to balance their books.
When hedge funds need to show their investors what they've accomplished, when pension funds need to rebalance their portfolios, and when everyone in finance needs to make their numbers look good for the annual reports, this creates something called the year-end effect. Suddenly, every major player in the market is trying to do the same thing at the same time. They're selling using positions to lock in tax losses. They're buying winning positions to inflate their performance numbers. They're moving massive amounts of capital around to meet regulatory requirements. Under normal circumstances, this year-end shuffle causes some volatility, but nothing catastrophic. The market absorbs the pressure and moves on. But these aren't normal circumstances. We're dealing with the highest inflation in decades, central banks that are fighting to regain credibility, a banking system that's more interconnected and fragile than ever before. When you combine the natural year-end pressure with these underlying weaknesses, you get a perfect storm, a moment when the normal flow of money through the financial system can simply break down. Think about it this way. Liquidity is like water flowing through pipes. Under normal conditions, it moves smoothly from one place to another.
But when too many people try to turn on the top at once, the pressure builds. The pipes start to crack.
And eventually, the whole system backs up. That's exactly what's happening right now. The demand for liquidity is increasing while the supply is shrinking. Central banks are no longer pumping money into the system like they did during the pandemic. Commercial banks are tightening their lending standards, and institutional investors are becoming more cautious about providing the capital that keeps markets functioning. The warning signs are already visible if you know where to look. Treasury markets, which are supposed to be the most liquid in the world, have been showing unusual stress. Spreads between bid and ask prices have been widening. Trading volumes have been dropping during what should be active periods. And most telling of all, the Federal Reserve has been conducting emergency operations to keep the overnight funding market stable. These aren't normal market conditions. These are the early symptoms of a system under pressure. And as we approach the year-end deadline, that pressure is only going to intensify. But here's what most people don't understand about liquidity crises. They don't announce themselves with sirens and warning bells. They creep up slowly, then strike with lightning speed.
One day, everything seems normal. Trading is orderly, prices are moving in predictable ways. Then suddenly, without warning, the market gaps down. Orders stop getting filled, and panic sets in. The speed of modern markets makes this even more dangerous. High-frequency trading algorithms can amplify selling pressure in microseconds. Social media can spread fear faster than any previous generation has experienced. And the interconnectedness of global markets means that a crisis in one region instantly spreads everywhere else. This is why understanding what's coming isn't just academic, it's survival. Because when liquidity dries up, it doesn't matter how smart your investment strategy is or how diversified your portfolio looks on paper. If you can't sell when you need to, if markets are frozen, if banks stop lending, then all your careful planning becomes worthless. The smart money already knows this. They're quietly reducing their exposure to risky assets. They're building cash positions. They're buying insurance against market crashes. And they're positioning themselves to take advantage of the opportunities that always emerge from chaos. Because here's the thing about liquidity crises. While they're devastating for unprepared investors, they create incredible opportunities for those who see them coming. Assets get sold at fire sale prices. Strong companies become available at discount valuations, and patient investors with cash can accumulate positions that will pay off handsomely when normalcy returns. The question is whether you'll be among the prepared or among the surprised, whether you'll be forced to sell at the worst possible moment or positioned to buy when others are panicking. What happens next depends entirely on how you respond to what's coming. The liquidity crisis isn't a possibility, it's a probability that's getting stronger every day. The only variables are timing and magnitude, and both of those are being determined by forces that are already in motion. The forces shaping our financial future aren't random. They're following a script that's been written by decades of policy decisions, market structure changes, and human psychology. And right now, that script is pointing toward a climax that most people aren't prepared for. Let me paint you a picture of what the next few weeks could look like. It starts quietly. Maybe a few hedge funds announce they're reducing leverage. Perhaps some corporate bonds start trading with wider spreads. Nothing dramatic, nothing that makes headlines, just small signs that the machinery of finance is starting to strain. Then the calendar pressure kicks in. Portfolio managers realize they need to show gains for the year. Risk managers start demanding that positions be reduced. Compliance departments begin enforcing year-end rules more strictly. What once was a gentle current becomes a rushing river of forced transactions. This is where the mathematics of markets becomes dangerous. When everyone needs to do the same thing at the same time, prices don't adjust gradually. They gap, they jump, they move in ways that break the models and assumptions that most investors rely on. Consider what happened in the bond market during the pension fund crisis in the United Kingdom just over a year ago. Gilt yields didn't rise steadily, they spiked violently as forced sellers overwhelmed the market's ability to absorb supply. The Bank of England had to intervene within days to prevent a complete breakdown of the system. That was just one country. One market, one crisis. What we're facing now has the potential to be global in scope because the underlying problems exist everywhere simultaneously. The debt situation alone is staggering. Global debt to GDP ratios are at levels that would have been unthinkable just 2 decades ago. Corporate balance sheets are loaded with borrowings that made sense when interest rates were near zero, but become problematic as rates normalize. Government finances are stretched thin from years of stimulus spending and pandemic response measures. When liquidity becomes scarce, this debt doesn't just sit quietly on balance sheets. It demands attention. Companies that need to refinance discover that capital is no longer freely available. Governments find that rolling over their obligations requires paying much higher interest rates. And individuals who relied on easy credit find themselves facing a very different financial reality. The ripple effects cascade through every corner of the economy. Real estate markets that depend on mortgage availability start to freeze. Small businesses that rely on credit lines for working capital begin cutting operations. Consumers who built their spending habits around available credit suddenly find themselves forced to save instead of spend. But the most dangerous aspect of a liquidity crisis isn't what it does to prices, it's what it does to confidence. Because liquidity isn't just about money.
It's about trust. It's about the collective belief that markets will function, that counterparties will honor their commitments, and that the system will continue to work. Once that trust begins to crack, the crisis becomes self-reinforcing. People start hoarding cash, not because they need it immediately, but because they're afraid they won't be able to get it later. Banks become reluctant to lend, not because borrowers are necessarily risky, but because they're uncertain about their own funding needs. Investors begin selling, not because they want to, but because they're worried about being unable to sell tomorrow. This psychological component is what makes liquidity crises so difficult to predict precisely and so devastating when they occur. The transition from normal market conditions to full crisis can happen in a matter of hours once the confidence feedback loop begins. The Federal Reserve and other central banks understand this dynamic. They've built tools specifically designed to combat liquidity crises. Emergency lending facilities, quantitative easing programs, direct market interventions. These weren't created randomly. They were developed in response to previous crises and refined based on hard-learned lessons.
But here's the uncomfortable truth about these tools. They work best when used early and aggressively. Once a crisis is fully underway, once confidence has been shattered and markets have seized up, even the most powerful central bank interventions become less effective. This creates a cruel paradox for policymakers. Acting too early risks creating moral hazard and encouraging excessive risk-taking. Acting too late risks allowing a manageable problem to become a systemic catastrophe. The timing has to be precise, and the political will has to be absolute. Right now, central banks find themselves in an especially difficult position. After years of ultra-accommodative policy, they're trying to fight inflation while simultaneously watching for signs of financial instability. They're walking a tightrope between two potentially devastating outcomes, and the margin for error is shrinking every day. The market structure changes of the past decade have made this balancing act even more precarious. The growth of passive investing has concentrated enormous amounts of capital in index funds that must buy and sell based on mechanical rules rather than market conditions. The rise of algorithmic trading has created feedback loops that can amplify volatility in ways that human traders never would. Electronic trading platforms have made markets faster and more efficient under normal conditions, but they can also transmit shocks more rapidly when things go wrong. The same technology that allows you to trade from your phone can also propagate panic across global markets in milliseconds.
These structural changes aren't inherently good or bad. They're simply different, but they create new types of risks that previous generations of investors and policymakers never had to consider. And we're about to find out how well our financial system can handle these risks under severe stress. The December 31st deadline isn't arbitrary. It represents the convergence of regulatory requirements, accounting standards, tax considerations, and performance measurement cycles that all demand resolution simultaneously. It's like a massive traffic intersection where all the lights turn green at the same time, but the roads can't handle the volume. Smart institutions have been preparing for this convergence for months. They've been building liquidity buffers, reducing leverage, stress testing their portfolios. But not everyone has been so prudent.
And in an interconnected financial system, the weakest links determine the strength of the entire chain.
The question isn't whether some institutions will face difficulties. The question is whether those difficulties will remain isolated or spread throughout the system, whether the firewalls that regulators have built will hold, or whether we'll discover that the connections between different parts of the financial world are stronger than anyone anticipated. The answer will likely become clear in the coming weeks, but the early indicators suggest we're heading toward the latter scenario. The stress fractures are already appearing in places that most people never look. Corporate credit markets are showing signs of strain. Municipal bond issuances are being postponed. Even the repo markets that banks use for overnight funding are displaying unusual patterns. These aren't headline-grabbing events. They're subtle shifts in the plumbing of finance that only become visible to those who know where to look. But they're the canaries in the coal mine, warning us that something fundamental is changing beneath the surface of seemingly calm markets. The timing couldn't be worse for individual investors. Most people have their largest financial exposures right now. Their retirement accounts are fully invested. Their real estate holdings are leveraged to historical norms. Their emergency funds have been depleted by years of inflation and economic uncertainty. When the liquidity squeeze intensifies, these investors will find themselves in an impossible position. They'll need to raise cash precisely when cash is most difficult to obtain. They'll be forced to sell assets exactly when those assets are trading at their lowest liquidity premiums. And they'll discover that diversification only works when markets are functioning normally. The wealthy and institutional investors have advantages that retail investors simply don't possess. They have access to private credit markets that don't depend on public liquidity. They can negotiate directly with counterparties instead of relying on exchange-traded instruments. They have relationships with prime brokers who will provide financing even when markets are stressed. The storm is coming, and the only question that matters is whether you'll be swept away by it or positioned to weather it. The liquidity crisis after December 31st isn't a distant possibility. It's an approaching reality driven by forces already in motion. The smart money has already moved, the warning signs are flashing, and the calendar is counting down to a moment that could redefine how we think about financial security. Your preparation today determines whether you'll be among the survivors or the casualties when the markets finally run out of breath.